What happened on Friday. There's a whole bunch of rumors going on about what happened in the silver market because it was up 6, 7% or whatever it was in the CME. The Chicago Mercantile Exchange, the biggest derivatives exchange in the world, I think. Well, it went down because there was a coolant leak or there was a Fukushima thing or some kind of tsunami or earthquake. I don't know what it was. It was probably, I'm just making up a bunch of stuff. I don't know what it was.
A frequency harmonic between the deflector and the shield grid using the warp field generator as a power flow anti-attenuator, and that, of course, naturally created an amplification of the inherent energy output.
And everyone's like, well, maybe this was a planned action because the liquidity was thin and they wanted to shut down COMEX so people couldn't stand for delivery. And I don't really believe any of this stuff. I mean, it could be true, but there's a larger point here. And the point I want to make is that this doesn't really matter because at one point, at some point, there's going to be an oopsie at the COMEX and it's going to stop working because gold is going to go into a backwardation. And that means that all commodity exchanges are going to go down because the dollar isn't going to work anymore. And then gold is going to become the money. And then all other commodities are going to be denominated in gold and silver terms. But while that transition takes place, all of the derivatives exchanges, futures and options on futures and all that stuff, it's going to go down. So at one point, it is going to go down. Now, what you don't want to do is get sucked into a narrative that says this is the point where it's going down, and that's why you have to go all in on gold and silver right now. Never go all in on gold and silver. You always have to have some amount of dollar liquidity, even as we get to the end game, because you never know what exactly is going to trigger, and you don't want to be in a situation where you have $0 to deal with whatever you need to pay for in the immediate sense. So, while all these narratives are fun to speculate on and whether
Analyst Rafi Farber presents evidence of precious metals market stress. Mathematical proof of a gold short squeeze. 60,000 contracts closed. Price up $250. Silver draining from New York with premiums hitting zero, and palladium heading for record deliveries. Gold mining stocks are at critical support levels, while Treasury yield curves show pre-recession patterns. Core message: ignore conspiracy theories about market incidents, maintain dollar liquidity, and keep accumulating physical metals for the eventual dollar collapse transition. Thanks for watching. Subscribe to Fine Metals for more updates.
Now, we're going to go to the silver drain from New York. It continues. It ebbed here for a while, for about 2 or 3 weeks, from the end of October to the middle of November, and then it has accelerated again. Now we are at 458. Over here, 458 million. From the beginning, from the huge London spot premium, we were at 532 million. Now we're at 458. That's about 80 million something contracts, not contracts, 80 million ounces of silver have been drained from New York. Most of it probably going to London, though probably not all of it. Some of it might be going to Shanghai. We'll see when we have those numbers. The Shanghai silver stocks, by the way, are at 10-year lows at 520 tons. This is actually 10-year lows. So we see here 520 tons. What is going to cause silver to flood back in? There's going to have to be a Chinese or a Shanghai premium on silver. We'll see if they can get that, or maybe there's going to be problems in Shanghai. Who knows? The exchanges are under stress. Maybe the cooling incident had something to do with it. Now we're going to go to palladium. There is some exciting stuff going on in palladium right now. Here we see, this is from 2 days ago. There is 557 contracts left in the December contract on the last day of this contract as a futures contract before it goes to delivery. So there's going to be at least 557 deliveries of palladium, and there's probably going to be more if there's going to be spot buys, which there always are a few of in the month. You can see here on the bottom, this is from November 17th, 2020. This is the yearly deliveries. And we see here, this is palladium. So this is the record all-time deliveries. You can see here 570 contracts. So we're probably going to break that this month. It's going to be at least 557. It's probably going to be more than that. Has to do with gold stocks. This is the gold to Huey ratio. The higher this is, the cheaper gold stocks are in terms of gold. The lower it is, the better gold stocks are performing in terms of gold ounces. So we see here, we have re-hit a major trend line that has been in place since 2016. This is the all-time bear market low in gold stocks in the end of 2015. This is the 2020 crash. And here is the bottom trend line. It was hit in 2016. It was hit again in 2020 during that gold bull run, gold stock bull run. And here it is hit again just a few weeks ago, and we're touching it again over here. So it looks like this trend line wants to be broken. If it is going to be broken, we have a long way to go before we get to 2011 lows here at about 3. And it goes even below that, meaning that gold stocks are even better relative to gold. Once we break this trend line, we're in space here. And it could get pretty exciting for the gold miners and the gold streamers, and of course the silver stocks as well, which had a fantastic day on Friday. We have a giant gold miner triangle on the gold to XAU ratio. XAU is just an older measurement or an older index for gold mining stocks. It's bigger companies, I think. So we can see here that we have this very similar looking trend line that goes back to 2012, and it's been hit here twice in the last few weeks. It was hit in 2021 and in 2022. The lower this goes, the better gold stocks are relative to gold as before. But you can see here we've tagged the upper trend line 3 times. And the most recently in about February, March 2025. And this trend line is going to break, and we're going to head towards the 2011 lows at 6, and we're now at 13. So that means that gold stocks are going to double in value relative to gold. So on the latest silver move, up to $57, we have here the junk silver premiums have hit 0. I think the feed for this data is from Monex or Monex, or however it's pronounced. I think that's where they get it from. You can see here that the premium on junk silver coins, which I think is the most appropriate form of silver because it's the most recognizable in the smallest denominations at the smallest premium. That's 0.04%, essentially 0. You can get junk silver, physical silver coins for the same as spot right now. So this is a pretty good deal. Anyway, we're going to go to the next slide here. London spot silver premium returns. Yes, silver went up to $57 yesterday or on Friday, on Black Friday, on low liquidity and low volume. So we have here, this is the silver future spot silver spread. When it's negative, that means there is a premium for New York silver over London spot. Some people call this backwardation. I don't call it backwardation. I just call it a premium on New York. But whatever you call it, it's happening again. You can see this was the record premium in New York in October when silver hit about 54, 55. Everyone was freaking out about that. And we got rid of the premium. This is the normal state of the market. This is a sort of a kind of a backwardation, but not really a backwardation. I have other videos on why it's not a backwardation. I'm not going to discuss that right now. But anyway, the New York premium or the London discount on London spot silver has now reappeared. It's at 0.3%. It was down to 1% as of 2 days ago, or I think that was Wednesday, right, the day before Thanksgiving. So the conditions that led to silver flooding into London from New York have reasserted themselves. Let's go to the next slide here. You can see here why this is probably the bottom in gold, and by extension silver is already in. It's not going to help you much with silver because we're at new all-time highs, but we're not yet in gold. We're at 4250. I think the all-time high was close to 4500. But we see here the interaction between the price and open interest here. Every time we have hit this level of open interest or near it, we have hit a bottom in gold. You can see here, this is when we were back down to about 400,000 contracts in March of 2024. This was a bottom in silver prices. It took price a few weeks to move from here, but it didn't go any lower than this. Same thing here. We hit about 400,000 in June, July 2024. Again, we see a local low in gold here, and from here it went up. We see it again over here. This one took longer, but price did not move substantially lower than this area. It was between about 3,500 and 3,200, 3,300. It was bouncing around very tightly, not because of, but in correlation with open interest, the amount of contracts open on the New York futures market. It was around this number, and price did not go substantially below here. So now we are at 420,000, I think. This is on day old. This says 432,199, but we are at about 420,000 now because of deliveries that have been made in the last few days, and that closes open interest, that closes contracts. So you can see here is a bottom. I don't think we're going to go below 4,000, maybe never, maybe only once in the final crunch. I don't know, but even if we do, it's not going to be for a very long period, so I wouldn't even try to time it at all. This is very likely a bottom here in gold, and we can see that from the open interest, and it's going to be the same pattern here. 10-year yield triangle reaching the apex. Has to do with the 10-year yield. We can see that we are in a tightening triangle going back to 2023. This is a pretty tight downtrend line in the upper triangle portion, whatever you call that. I don't know. It looks like we're going to break this one way or another. And we could break it down and that means that bonds are going to go up and interest rates are going to go down, especially if the Fed is forced to print money. That could be a signal that the final printing round is almost here, or we could be in a deflationary collapse and go higher here. Triangles are unpredictable. They're going to break one way or another, but it's hard to tell which way they're going to go until they break. So something big is right down the pike here. And the yield spread is coiling. The yield spread between the 10-year and the 3-month. Whenever this goes below zero and then goes back above zero, when it goes back above zero, that's when you have a liquidity event, a recession, a depression, whatever you want to call it. We saw it in 2000 and in 2007. This was right before the 2008 financial crisis. And this right here, when it went below zero, was right before the 2020 humanity crisis of insanity. Let's not speak of it. But here we see that we've been above zero for a while and we're coiling just around the 200-week moving average. I think it was over here. This is very strange behavior because once it breaks back above zero, then this spread doesn't usually hang around for so long and in such a tight formation. You can see here, it didn't over here. It just went kind of straight up. Also didn't over here in 2000 after it broke back above zero. In 2000, 2001, just kind of went straight up with a little bit of back and forth. But here it's just been, something is forcing this down and it's going to break pretty soon. And so to end this off, I want to begin where I started. And that is, don't pay too much attention to the theories going on about what is happening in the CME, because all you have to know is that the CME and all the other gold and silver exchanges and the other futures exchanges and everything, it's all going to collapse once the dollar collapses, because everything is dollar denominated on these exchanges. And once the dollar collapses, then no more trades in dollars can be made. You have to trade in gold and silver instead. That's going to take a little bit while to recalibrate, and in the meantime the exchanges are going to go down. That's going to happen eventually. I don't know that for sure. I could be wrong, but I'm just going after the last 3 instances of when this happened. When we hit this level in open interest, we're hitting it again. I think we are at or close to a bottom in gold that has already been hit. Now we're going to go to the next chart here, and this is where we see the short squeeze. It's not an incredible or spectacular short squeeze, but mechanically that is what's happening. How do we know this? Because since the middle of November, right, we see here that open interest, I drew the line here, was about 480,000 contracts. Now we are down to 420. That's 60,000 contracts down, closed out. And in that time period, we went up from $4,000 to $4,250. So contracts are closing out and price is going up. That means that shorts are closing at higher prices. That is the definition of a squeeze, and that's what it is. That's what's going on right now. And we can see this in the numbers. What exactly is happening? So here I have 3 open interest dates from the CME website. This is the November 24th, November 25th, and November 26th, the last 3 trading days of the December contract until it hit delivery, until first notice. So you can see here, Monday, November 24th, what is happening? December 25th contract loses 62,400 contracts, and it rolls over, the rollover to February, right? You sell the December contract, you buy the February contract so that you don't have to deliver. If you're the short, basically you are buying back the short December contract, and then you are selling the February contract. So we're going to take this from the position of the shorts, from the perspective of the short positions. What is happening here is they bought back 62,000 contracts to close the position, and they only bought back 29,786. That's about, for every 2 contracts they bought back, they only sold 1 contract forward to February 2026 to maintain only half of the short positions that they had in December. But we see the same thing in November 25th, the next day, slightly less strong or less extreme. 52,000 contracts were bought back by the shorts, and only 39,308 were sold forward. So again, they're closing out the December position, and they're not covering as much in the rollover to February. Right? Same thing on the last day, and Wednesday, November 26th, we see 12,251 contracts were closed out. The shorts bought back that many contracts and only sold 9,787. So what is happening here is that the shorts are buying back their positions, but they're not rolling over, and they're not holding to delivery because they don't want to deliver, and they don't want to hold the short contracts into February, and therefore fewer contracts are being sold forward in February, or sold short in February, which means the price is going up because not as many people or not as many parties are willing to sell the contracts at this price.